So, without any further ado, let us begin our third technical session. There is a proverb which says, "The art is not in making the money, but in keeping it," and financial planning is a must for it. For this technical session on strategies in personal financial planning, we have with us CA Nilesh Shah, who is the Group President and Managing Director of Kotak Mahindra Asset Management Company Limited. He was part of the team that has received the Best Fund House of the Year award at all the mutual funds where he worked, including Kotak Mutual Fund, ICICI Prudential, and Franklin Templeton over the last 3 decades. Mr. Nilesh is the chairman and member of various committees, including a part-time member of the Economic Advisory Council to the Prime Minister. Nilesh was featured in Top 50 People of India by India Today for the year 2020. With this, I welcome you to the session, sir. Over to you.
Thank you. Very good afternoon to everyone. Thank you, Karnataka State CA Association, for inviting me. Money is a very touchy and emotional subject. Many of us believe that money is not everything in life. One should not be mad after money. In Gujarati, my mother tongue, there is a proverb which says that "Paiso hath no mel chhe." Money is the dirt of the hand. While our culture discourages money accumulation, I have found this quote of Warren Buffett very interesting. He says, money is not everything in life. Money doesn't matter. But make sure that you have made enough money before you make such statements. Undoubtedly, our culture tells us to worship Lakshmi Mata and Saraswati Mata together. It is extremely important for people to build enough in terms of money power so that your life can become financially independent. Money doesn't buy everything, no doubt about it, but money does buy lots of comforts and luxuries of life, which is pretty good. Now, if we come to money, many people have different versions about making money. Just next to Karnataka, there is state of Kerala, where people believe that buying lottery is the way to make money. They spend more money on buying lottery than putting money in bank deposits or mutual funds. There is a state like Gujarat or Rajasthan where many people invest in equities market disproportionately higher compared to other states, and they believe making money is via equity market. There is a set of people who believe buying gold is the best way to make money. As there are different ways to reach nirvana, there are different ways to make money. Making money is very simple, very commonsensical, but unfortunately, most people lack common sense to make money. Let me tell you some stories, real life incidences, which hopefully weave the narrative about how to make money, how to structure personal finance strategy. Let me start with the story of a friend's uncle who in the 70s and 80s was working as a head clerk in one of the chartered accountancy firm in Mumbai. Their firm was situated in Flora Fountain area near to Bombay Stock Exchange. And the partners used to trade stroke invest in stock market. In those days, it was physical settlement. One had to bring contract notes. One had to fill transfer forms. One had to go for bandho or bed delivery. My friend's father used to go through this whole process, and he slowly started observing the pattern where his partners were losing money by trading and where they were making money by investing. He was just a head clerk. His salary was meager. His savings was even less. But whatever was available to him, he used it for investment in stock market. Luckily for him, in those days, courtesy George Fernandez, many multinational companies came out with IPOs at a throwaway prices, and he accumulated fairly good quantity, albeit small quantity, in those companies. Over next 2-3 decades, his wealth continued to grow, and when he retired, his net worth was probably higher than many of his partners' net worth. His partners earned money, but they didn't invest it wisely. My friend's father earned less, but he invested wisely, learning from the mistakes of his partners. And that's how he built his net worth. The moral of this episode is making money does not require a chartered accountant's degree. A common sense is good enough to make money. The second thing which I want to bring about is need for financial advisor. Many people have lost money trading in stock market or investing in stock market based on the tips given by people. They don't really put sincere effort in understanding a company or finding an advisor who can help them manage their money. When we have disease, we go to a doctor, get the prescription, and then go to medical shop. None of us will go directly to medical shop explaining our disease and hoping to get medicine, or worse, going to the medical shop and picking up medicine without consultation with doctor or the chemist. When people try to invest on their own, it's akin to buying medicine from medical shop without doctor's prescription or chemist advice. In investment, you require balance between fear and greed. You require discipline. You require hand-holding by a third person who can help you balance your fear and greed. Last year, around same time, COVID-19 was looming on horizon. We hadn't announced the lockdown. But as soon as lockdown was announced, equity market started correcting. My colleague had gone to meet his family doctor, and he called up from there as his doctor wanted to speak. The doctor said that, look, I'm a medical professional. I don't have time to go through these ups and downs of markets. And when I see my portfolio losing money, I feel very bad and I don't get peaceful sleep. Now I want to sell everything and move into bank fixed deposits where I know at the end of a particular tenure, I will get so much money. I requested him that please don't make that mistake. Please stay invested. These are not the levels to sell. And he said, Nilesh bhai, do you say that this is the level from which markets will not go further down? I said, even God won't be able to tell you that this is the bottom of the market. But my recommendation is that don't rush into a decision. You have already taken the pain. Please stay invested. He didn't listen to me, sold all his equity mutual funds, shares, put money into bank deposits. After 3 months, he again called up saying that Nilesh bhai, in 3 months, stock market has delivered more return than what I was going to get in 3 years in bank fixed deposits. Now, what should I do? I said, you wanted peaceful sleep, so you should go back to sleep. Now, a medical professional trying to take decision on his own on finance is not appropriate. All of us require a financial advisor who can determine our risk profile, who can determine our investment objectives, and who can create a plan which will help us achieve our objectives. That financial advisor, that mutual fund distributor is professional, just like chartered accountant. They provide service to the best of their ability. And over a period of time, if you follow their advice, you will see achievement of your investment objectives. The third thing about investment is being optimistic. There are all kinds of people in the world. Some people are born optimistic, some people are born pessimistic. In the world of investment, pessimists sound intelligent, but it is optimists who make money. Long before I had gone to Jolly Gymkhana, a club in Mumbai's Ghatkopar area, there was a talk about equity market just like today, except that it was physical in nature. It serves one of the best food in that area, so a lot of people had come to attend. At the end of presentation, there was question answer session, and one about 80-year-old person got up and said, Nilesh bhai, whatever you say is bullshit. Equity market is gambling. I will never recommend anyone to invest in equity market. Who knows what will happen tomorrow, blah, blah, blah. It was very strange to hear that old gentleman cribbing like this, since he was making comment and not asking question. I moved on to someone else. After the end of question answer session, a gentleman came up and said, Nilesh bhai, I'm sorry, my father, argued against you. And I said, what happened? So he said, it's very simple. My father is pessimistic in nature. He's always worried about future. And which is why he have remained invested in very conservative products like bank fixed deposits or public provident fund or provident fund. Whereas in Ghatkopar area, all our neighbors, they are equity investors stroke punters. Ghatkopar area alone trades more in equity than probably some of the states put together. So obviously those neighbors have made money and gone up in life. We are where we were before. And that has created more pessimism, more negativity in my father. He believes everyone else has gone up through some shortcut in life, whereas he has remained behind because he is, the right person. This kind of pessimism, this kind of pessimistic attitude towards life or future is not going to help you make money. You have to always believe that tomorrow will be better than today. That optimism will allow you to remain invested over a longer period of time. Warren Buffett always recommends, don't go short against America. I will say that don't go short against India. In 1980, Sensex debuted at about 100. Today, it is 50,000 plus. In last 40 years, we have seen war with Pakistan, clashes with China. We have seen economy going up and coming down. We have seen our FX reserve in form of gold getting pledged. And we have seen FX reserves touching $585 billion. We have seen oil prices crossing 100. We have seen oil prices touching 10. We have seen prime ministers getting assassinated. We have seen governments getting formed with majority and governments getting fallen because of losing majority. We have seen all kinds of ups and downs, and yet India has continued to progress. So, in investments, be optimist. Don't go short on India. That's extremely important if you want to make money. The other thing about investment, especially in my community, many people believe that trading is the best way to make money. Many of my cousin brother feels that Nilesh bhai, you come on television, so you will know exactly what's going to go up tomorrow. So please tell us what we should buy in the morning. We will sell in the afternoon, and in the evening we will be at home with the cash. Now, there's no way in the world one can make money like that. Buy in the morning, sell in the afternoon, and in the evening you are sitting with cash. That kind of trading doesn't happen. In fact, I will say that trading is injurious to financial health. In trading, 99 out of 100 people lose money, whereas one rare individual with tremendous discipline make money. Let me give you a story about trading. This is about a person called Jesse Livermore. He wrote a book called Reminiscence of a Stock Operator. It's even today considered most important book for traders. In 1929, American markets crashed big time. In those days, New York was a small city, unlike today. The stockbroker community was staying in one part of New York. From morning onwards, news started coming, markets have corrected, stocks have fallen, people have lost a lot of money. One of the biggest stockbrokers of that era committed suicide by afternoon. And as the evening shadows started coming down, people were walking back dejected. The entire area was covered with a lot of gloom. Our friend Jesse Livermore didn't return home. His wife was getting worried. And eventually, after a week, she saw Jesse Livermore coming. She ran out of the house, assuming that her husband also has suffered huge losses like everyone else, and started comforting her that, Jesse, don't worry. If you have lost money, it's fine. We can sell this house. I can start working again. We'll survive. We will figure out a way. Jesse Livermore was surprised and said, what are you talking? Of course, I'm going to sell this house because this is too small a house. Why should we stay here now that I have made so much money? On a day when everyone else lost money, Jesse Livermore returned home with what is considered the highest ever profit made by a trader of about $1 billion in today's terms. When everyone lost money, the entire market corrected. Jesse Livermore made money because he was on the other side. He was short market. He made in today's term $1 billion. Who could have been better trader than Jesse Livermore? What happened to him? In 1933, Jesse Livermore committed suicide because of trading losses. Please remember that even if you are Donald Bradman of trading, in the last inning, your score will be 0 only. Trading is a very, very difficult way of making money. It requires tremendous amount of discipline. It requires tremendous amount of perseverance. It requires tremendous amount of hard work. Most traders don't possess requisite discipline or hard work and hence lose money. So as an investor, you have better chances of making money. As a trader, you have better chances of losing money for an ordinary investor. The other thing which one has to figure out is to be a regular investor. We have a proverb which says that little drops of water make an ocean. Same way, regular investment over a period of time creates far larger wealth through the power of compounding. Many people wait to time the market. In that desire to time the market, people end up losing more opportunities. Our SIPs, systematic investment plans, I was looking at the data for February 21, has delivered double-digit return over last 1, 3, 5, 7, 10, 15, 20 years. These are fantastic compounding. How many people have enjoyed that ride? Very few. Because everyone wanted to time the market. No one wanted to just patiently do the regular investment. And it is quite surprising. People do regular investment for their physical health. For example, when a doctor gives you medicine for diabetes or cholesterol or blood pressure, you regularly take one medicine every day. You don't try to time medicine by combining 30 days medicine at one go or entire year's medicine at one go. Then you do regular consumption of medicine every day so that disease can remain under control and your physical health will be better. Now, if that is the case for physical health, why not do it for financial health? Keep on investing on a regular basis in market and let power of compounding make money for you. The second thing, apart from regular investment, is long-term investment. There is a proverb which says that if you want to eat mango, you have to wait for 12 years after planting a tree. I haven't seen anyone complaining to God that why do you make us wait for 12 years to get mango? Why not do it instantly? The way we wait for sweet mangoes to come for 12 years, same way we need to wait for our investments to produce better results. Investments, like businesses, compound over a period of time. They can't produce instant results. Becoming long-term investor creates tremendous amount of wealth for investors. Imagine stocks like HDFC, Kotak Bank, HDFC Bank, Asian Paints, Infosys, Wipro. What kind of returns they have generated for investors? In this audience, there will be many people who probably would have owned shares in these companies. And if they had continued remain invested in those companies today, the value would have been far more higher. So it is extremely important for one to be a long-term investor rather than trying to trade throughout the year. If I have to summarize what I have spoken till now, investment is all about common sense, which unfortunately is not commonly available. People need an advisor so that they can balance between their greed and fear, so that they can pursue a disciplined approach for achieving their investment objective. An investor by definition has to be an optimist. Pessimist sounds intelligent but doesn't make money. It's only optimist who makes money. Never short India. For last 40 years, India has continued to grow despite all the challenges. And in future also, India will continue to grow. To make money, one has to be a regular investor rather than market timer. The power of compounding works in your favor when you give regular investment and long-term investment. Like small drops of water make an ocean, Small sums of money invested on a regular basis for a long period will create a large amount of wealth. Investment is all about patience. It's all about sitting on your winners for a long period of time. This long-term tenure benefits investors significantly. To put it in a lighter way, if you read Ramayana, it shows that Lanka was made of gold. They haven't mentioned anything about Ayodhya, so I believe it won't be made of gold. That means Lanka was prosperous and Ayodhya was not as prosperous. Why was Lanka so prosperous? I would like to attribute that to Kumbhakarna's style of investing. As you know, Kumbhakarna used to wake up, eat, and then go to sleep for 14 years. My feeling is that Kumbhakarna also was investing in equity market, and then he used to go to sleep for 14 years. And by the time he was waking up in next cycle, his stocks would have done wonderfully well. And that style of investing actually helped Lanka become golden. That's the benefit of long-term investment. That's the power of long-term investment. Finally, if I have to summarize, the most important thing for an investor is asset allocation. In one seminar in Pune at Flame University, Ramesh Damani explained this concept of asset allocation. Ramesh Damani, Radhakishan Damani, Rakesh Jhunjhunwala, Nilesh Shah, these are all legendary investors of Indian equities. Ramesh Bhai has found most 100 beggars among 4 of them. That means he has invested in stocks which have grown more than 100 times, maximum number of times. Rakesh ji, Radhakishan ji, Nimesh Bhai, all have invested in far less 100 beggars than Ramesh Damani. And yet, their wealth is far more than Ramesh Damani. And Ramesh Bhai explained it very nicely that when they got 100 beggar, they loaded onto it. They bought as much as they could buy. On the other end, he didn't bought enough when he got an opportunity. So it's not how many 100 beggars you have got. Most important is how much money you put on table when you got that 100 beggar. That is the concept of asset allocation. It doesn't matter which stock you have bought. What matters most is how much quantity of that stock you have bought. There is this story about a legendary hedge fund manager. One day he entered his office and saw a junior doing like this. He was a bit surprised, so went to his junior and said, "Why are you so excited?" The junior fund manager replied saying that, "Sir, I have put up $1 million trade on this position." The legendary hedge fund manager told that junior fund manager that this is a very bad trade. The whole market is going against you and you will lose money rapidly. The junior fund manager then brought his analysis and said, "Look, the whole market is wrong. And I have done careful analysis of all the factors and I believe this stock will bounce from here." Now that legendary hedge fund manager told this junior that you are the biggest idiot I have seen. Now the junior fund manager got hurt. He said, "Look, first I told you I have put up $1 million trade. You scolded me saying that I am wrong and market is right. Now I have proven to you that I am right and market is wrong and you are saying I am still an idiot. How can that be?" So this hedge fund manager told him that when you have got a trade of your life, you don't put $1 million trade on it. You put $1 billion trade on it. You load it up to the extent that you can. So effectively, you have to bet big when you're confident. You have to lie low when you're not so confident. What does most people do? They experiment with small amounts. And when they get confidence, whether the opportunity is good or not, but based on my past track record, based on my confidence, I go and end up taking a big position. And that eventually backfires. effectively, do remember that you have to bet big when you're confident, and you have to lie low when you're not so confident, when there is no clarity. Now, let me bring this all together in today's terms. This is all theoretical knowledge. Be a long-term investor, be a regular investor, be a disciplined asset allocator, be an optimist, be an investor rather than a trader, have financial advisor who will decide your objectives and risk profile. This is all theoretical stuff. How do we convert it into practical life? What do we do today so that tomorrow we are more wealthier? My feeling is that today India is standing at a great opportunity. For last 10 years, it has done multiple things to transform itself. Earlier, we were high inflationary economy. Now, we have become low inflationary economy as RBI has been mandated with inflation targeting. Earlier, we were high fiscal deficit country. Now, despite COVID-19, we are at lower level of fiscal deficit. Earlier, our lending was creating NPAs because bank financing decisions were taken outside of banks' headquarters. Now, banks are not influenced by outsiders. They take decision based on the merit of the case. And hence, commercial lending, instead of creating NPAs, is actually creating economic growth. Earlier, we were infrastructure deficit economy. There were times when to get a telephone line, we used to wait for 10, 15 years. To get a Bajaj scooter, the waiting period was more than 10 years. Power cuts were part and parcel of life. Highways were hardly in existence. Today, India is moving towards becoming infrastructure surplus. There are challenges, no doubt about it. But today, we are surplus in power. Our highways have become better. Our airports have become better. Our ports have become better. So India is moving from infrastructure deficit to infrastructure surplus. We haven't reached there, but we should be reaching there over a couple of next years. India earlier was physical economy. Now it is physical plus digital economy. Our apps and products like Aadhaar, Bheem, UPI, they are all world beaters. They are all excellent digital properties. If all these assets were in private company, they could have billions of dollars of market cap. But we are keeping them for public good, and hence they are not listed. India is also transiting from restrictions which had curtailed India's growth for years to newer ideas. When we got independence, we took a left path instead of taking the right path. We followed Soviet Russia model of centralized planning. We gave priority to public sector enterprises. And for almost first 5 decades, we saw Japan, Taiwan, Indonesia, Philippines, Malaysia, Thailand, Korea walking over us, running ahead of us, leaving us behind. But we didn't change our game plan. We continued to stick to the left path of giving commanding heights to public sector enterprises, curtailing Indian entrepreneurs. 1990s debacle pushed us to liberalize, and Indian growth rate moved from 2 and 4% range to 5 and 7% range. Today, in this budget, government has announced that they will be moving out of they'll be moving out of all those sectors other than 4 critical sector of economy. This privatization divestment by government is a game changer. This can remove the restriction which India has enforced upon itself from a growth point of view. When Air India was Tata Airlines, it was one of the world's favorite airline despite its smaller size. When it moved into government's control, it ended up having more number of employees per plane than passengers per plane, and hence perennially loss-making. Tomorrow, the same Air India in the hands of Tata's or someone else will again become world-beating airline. Hindustan Zinc in the hands of Government of India was making 100,000 tons zinc and losing money. Today, it's in the hands of private entrepreneur, makes 1.6 million tons of zinc and makes money. So India is transiting and removing its barriers which have restricted itself. Put all these things together, time has come to say that don't short India, don't go against India, participate in India's growth story. Equity market today have run up significantly from March low. You never know what will happen on Monday morning. Markets could correct, markets could rise. But if you take a 5-year, 10-year, 15-year, 20-year view, undoubtedly Indian equities will do well, and investors who invested in Indian equity will also do well. The best way to invest in equity is via regular investment, via systematic investment. If you can do direct investment, go ahead and do it, but please ensure that you must give time and efforts in understanding companies, in analyzing companies. If you don't have time and inclination, you can always come by equity mutual funds. There are asset allocator products available in mutual funds. Many of them have delivered double-digit return over the last 1, 3, 5, 7, 10 years. If your portfolio has not delivered that kind of return, then certainly it makes sense for you to be part of asset allocator funds. Overall, India is going to grow tremendously in the coming years, and investing in equity market will give you ability to participate in that growth story. In terms of real estate, we think real estate should do well, especially commercial real estate, which are on the outskirts of city and where city is moving. I don't know much about Bangalore or Mangalore or Mysore, but if you see in Mumbai, at one point of time, Ballard Estate was commercial business district. Then it moved to Flora Fountain and Fort area. Then it moved to Nariman Point area. And now it has moved to Bandra Kurla complex. If you had kept your properties in Bandra Ballard Estate or Fountain or Nariman Point, they would not have delivered as much return as a property in BKC would have delivered. As the city shifted, so has the appreciation in real estate. So if you can go and invest in those commercial real estate where you believe city will shift, you will end up making money over there. And more importantly, if that commercial real estate can be put on rent, then at some point of time, rental income will start covering your EMIs. In terms of fixed income, please remember that there are hardly anyone who has become rich by investing in bank deposits. Most of the time in Indian history, bank deposits have delivered negative real rate of return. The coupon of bank fixed deposit is lower than the inflation, and hence investing in bank fixed deposits, people have actually lost money rather than made money. Our recommendation will be that please keep investment across debt, equity, real estate, and commodity in a balanced manner under the guidance of your financial advisor. Become a long-term investor, become a regular investor, and let the magic of compounding work for you. Making money is a simple thing. It's commonsensical thing. It doesn't require a professional degree. But unfortunately, most people become greedy when they see markets doing well and they become fearful when they see markets correcting, markets crashing. What one needs is exactly opposite. When everyone else is greedy, you have to be fearful. And when everyone else is fearful, you have to be greedy. That contra style is the best way to make money. With this, I will end my talk and open up for question answer. I've given very generic suggestions on how to make money, on how to build portfolio, how to become an investor. As I mentioned, there are multiple ways to reach nirvana. No one path is similar to another path. Each one can travel on different paths to reach same destination. But I think travel across all the paths will require same characteristics of being an optimist, of being a regular investor, of being a disciplined investor, of being a long-term investor, and maintaining disciplined asset allocation across different asset classes. Happy to take your questions.
Sir, you're able to hear a question? Hello?
Yes, now I'm able to hear you.
Yeah, okay. Sorry, sir. There are a couple of questions for you to answer. The first of it is, for investments when the markets corrected in March 2020, is it the right strategy to book profits now?
I don't think so. You have to book profit looking at the market. People make this mistake of selling when market rises. What you have to look at is the valuation. If valuations are cheap, why should you sell? And let me give you an example. In December 2019 quarter, Nifty 500 companies profit was 1,22,000 crore. In March, there were few days of lockdown, but profit came down to 53,000 crore. In June, it came down further to 32,000 crore. Now, obviously, those were the days when markets were looking expensive because profits were coming down. Now, if you had acted on that, it would have been a disaster because market was expecting a quick turnaround of profitability. In September quarter, profit came to 1,76,000 crore. It was almost 5.5 times more than what was declared in June quarter. When September number came out, people started jumping up and down saying that, oh, this can't be sustained. Well, the December quarter number has came at 2,10,000 crore. If you today assume that this 2,10,000 crore every quarter will sustain for next 4 quarters, we are looking at a corporate profitability of roughly about 8,40,000 crore. The current market cap is roughly about 200 lakh crore. You can do maths for yourself. 200 divided by 8,40,000. What is the P ratio of the market? Does it make sense to sell at this P? The market by nature will go up and down, but you should stay invested when markets are fairly valued or when markets are cheap. And right now, I will say that markets are fairly valued. It's not overly expensive that you should sell and move out. So don't look at the index level to book profit. Look at your asset allocation, look at market valuation, and then take a call. If you are leveraged today in the market, I will recommend you to book profit. But if you are equal weight allocation to equity based on your risk profile and investment objective, this is time to continue rather than sell.
Yeah. The second question, which is a very interesting question. I think the session actually meant business for the people who asked for it. the stocks which you recommend for investing in 2021.
So my job as a fund manager is to manage money. Why will I give you stock recommendation? Number two, even if I give you stock recommendation, how will I contact you when my view changes? Number three, I will give you experience. This was way back in the 90s when I had just started my investment career and I had gone to attend a marriage. In those days, legally, there was no restriction on me to give stock recommendation. Today, by law, I can't tell you stocks, but in those days, there was no such law. So one of my relatives came and said, "Beta, tu stock market mein kaam karta hai, bata, what should I buy?" So I told him that you should buy this liquor company. It's available very, very cheap. Indians are going to consume more liquor and the stock will do very well. I gave him that tip and moved out. We met after a 5-year period in another wedding. I had remembered giving him that tip because the stock had become almost 50, 60 bagger. In the wedding, this gentleman didn't even notice me. So I went to him and said, "Uncle, I had given you that tip. Remember, have you made money? Happy?" He said, "What happy? You gave the tip for 6 months, stock didn't move. I sold everything." It didn't matter that thereafter stock is up 50 times. So what is there in your takdir, you are going to get whether you get stock tip from me or not. But I will recommend you to invest in Kotak Mutual Fund and ensure that you make money.
Okay, sir. I'll go to the next question. While structuring the personal finances, is it necessary to consider the equity market? If yes, how can we mitigate the risk factor within?
See, risk and returns are part of the same coin. I mean, those people who say bank fixed deposit is safe, please go and visit PMC deposit holders in Mumbai. You will realize that bank deposits are not safe. Those guys who say company fixed deposits are safe, please go and meet Diwan Housing Finance Limited shareholder deposit holders. They are all crying today. Risk and return go hand in hand. There are people who say gold is a very safe thing to invest into. Please come to Mumbai and meet Goodwin Jewelers gold deposit holders. They all had given him money for 11 months, hoping that in the 12th month they will go and buy jewelry. What have they got? So you carry risk in order to generate return. They are together. You can't wish that away. The more risk you take, more return you will generate. Less risk you take, less return you will generate. And risk is in not knowing what you are doing. You know that putting hand into fire is risky, it will burn you. But thereafter, if you put hand on fire, it's not a risk, it's your conscious decision because you wanted to probably burn yourself. Same way in equity investments, when you know that there will be volatility, and I will overcome volatility by investing in good companies, by investing on a regular basis, by investing for a longer period of time, then there's no worry, then there is no risk. You just have to ignore short-term noise and stay invested for a longer period of time.
So the next question is a question which says, he has missed my chance to invest in last 20 years. Do you think we can make it in at the age 45?
Undoubtedly, yes. You started late, so be it. Indian growth story when I started my career was $200 billion. Today we are $3 trillion. By the time I retire, who knows, it will be $15 trillion. In $200 billion to $3 trillion journey, we have seen TCS, Infosys, HDFC, Kotak Bank, Reliance Industries, Sun Pharma, and so on and so forth. But 3 trillion to 10 trillion, 3 trillion to 15 trillion, imagine how many more companies we will create, how many more earnings opportunities we will create. What you have lost out is past. You don't cry on, split milk. That's behind you. From today onwards, start your journey. Be a regular investor. Be a long-term investor. Be a disciplined asset allocator. Take volatility in your stride. Get a good financial advisor who can handhold you when things are bad or when things are too good. This strategy will ensure that your returns will be more than inflation and you will make money which will make you financially independent.
The next question is the stock market a barometer of the economy?
So stock market is market. It can be influenced in the short term by money. It could be barometer of greed of the nation or greed of the investor. But in the longer term, stock market undoubtedly is the barometer of economy. For example, you will see many crooked promoters raising money from banking system. But in today's stock market, they are not able to raise capital. I don't want to name the people, but you will be able to figure out all those big NPS, how much money they were able to raise from equity market. Alok Industries had a 30,000 crore debt from banking system. Could he raise any money in Indian equity market? Answer is no. So stock market in the short term can be influenced by money, can be influenced by greed of investors, but over a longer period of time, it is barometer of the economy. It will differentiate good versus ugly. If that was not the case, today Infosys, Wipro, HCL Tech would not have been large IT companies. Pentamedia, Satyam, Silverline, DSQ, they would have been bigger IT companies. But that's not the case. It shows that stock market is barometer of economy over a longer period of time.
The next question is what is longer period of time? 5 years, 10 years, or 15 years?
So there is a advertisement by a watch company called Patek Philippe. I hope I have pronounced it correctly. It's a Swiss name, but ठीक है अपने इंडियंस उसको Patek Philippe बोल सकते हैं. They say that you own Patek Philippe to pass it on to your next generation. You are a mere custodian. You don't own, you just pass it on to next generation. To me, that advertisement is apt for stock market. You buy stock for pass it on to next generation. That kind of horizon is required. When we say long term, why stop at 5, 10, 15, 20, 30 years? Why not think of 50 years and 100 years? Now, it doesn't mean that we are blind to the company. Calico Mills was at one point of time large company. Today, no one knows whether it exists or not. So there will be ups and downs, mortality in company. But your investment horizon has to be long term at every point of time. It's like rolling 5 years, rolling 10 years, rolling 15 years, rather than rolling 5 days, 10 days, and 15 days. When you need money, you have to redeem your investments and use that. But when you don't need money, you should not unnecessarily redeem it.
The next question is how do you compare investment in gold versus stock market?
So in the gold, clearly right now our view is that it's $1,700 gold does provide great opportunity compared to fixed income. In this world of low interest rates and high liquidity, gold prices should get supported. The only problem for Indian investor is that gold in India has 10% import duty, 7.5% base duty, 2.5% surcharge. What is worth $100 of gold in Dubai is worth 110 in India. So you are paying 10% additional for that gold. Tomorrow, if import duty becomes zero, you will straightway lose 10% of rupee value of gold. Subject to that restrictions, gold is an asset class which an investor can invest today with a view to outperform fixed income. I don't think gold will outperform equity for probably over next 3 to 5 years.
The next question is also on the same similar lines. Where do you see gold reaching in next 5 years?
I really don't have a view on gold, but I do believe 5 years down the line, gold prices will be higher than today's level. And the return for investment in gold will be higher than the fixed income return, fixed deposit return.
The next question is trading in commodity derivatives better than equity derivatives, or is F&O market as a whole just a gamble?
So F&O market is a gamble in some sense. Now, again, please remember that gambling is not bad, but unlimited gambling is bad. You can't be Yudhishthir who doesn't know when to stop. In futures and options, there is a huge leverage. And that leverage can work both ways. You can make money, you can lose money. Now, in Mumbai, in Sion area, in 2000, one stockbroker had opened all women's branch. Many housewives staying in and around Sion Jain Society used to go to that stockbroker's office and trade in stock market. From cash, they went into futures and options without realizing what risk they were taking. They were very happy following the broker's advice, who will tell them to buy XYZ stock in futures. And by the end of the day, they will come back home with some money. Eventually, 2000 technology, media, telecom bubble busted. All these women's positions were open and they lost significant sums of money. The leverage which was giving them return also went against them and they started losing money and they lost money big time. It was a heart-burning experience where women, without recognizing what risk they were taking, were enjoying the benefits, and eventually risk came to hit them hard. Some of them even got divorced from their husband because their husbands were not cognizant of what risk they have taken. So my recommendation to anyone doing trading, be extremely careful. You are choosing a very, very difficult path of making money. Unless until you are technically qualified to trade, please remember that trading is injurious to financial health of an ordinary investor. You could be Donald Bradman of trading, but in the last inning, you will get out at zero only.
So the next question is on Bitcoin. So there are two questions. I'll combine them. What are your views on Bitcoin? The second question is, what is your view on Bitcoin and cryptocurrency trading if it is legalized in India?
So I think now cryptocurrency trading is legal in India. Supreme Court had removed the blanket ban imposed by RBI on trading stroke investment in Bitcoin. Now, please remember that Bitcoin is high risk, high return option. There is a set of people who are buying Bitcoin because they believe Bitcoins will continue to rise. Tomorrow, when they believe Bitcoin is going to go down, they will all move out. There's another segment of people who believe in Bitcoin because it allows them to move money from one country to another country without getting caught by central banks or investigative agencies. Whether we like it or not, the fact remains that all the illicit money from drugs to defense to other things are today getting routed via Bitcoin, and hence there is a demand for it. If you're looking to invest in Bitcoin, please be prepared to lose your entire money. If you have that ability, then only you should go towards Bitcoin. More importantly, do remember that you have to safe keep Bitcoin. Every day we hear stories of people whose hard disk crashed and their Bitcoins disappear. People forgot their password and their Bitcoin are locked in forever. So Bitcoin is high risk, high return investment. Today, fools are rushing in where angels are fearing. If you think you wouldn't bet an eyelid if you lost your entire money, with that kind of money, you can invest or trade in Bitcoin.
So the next question is an interesting question which asks, what is your view on growing dichotomy between equity market and real economy?
So real economy is backward looking. When data comes out, they are data of the past. So for example, for last 5 months, GST collection is more than 1 lakh crore. Now, if you were standing in May 2020, GST collection had dropped. In May 20, stock market was looking, saying that from September, October, November, December, Jan, Feb, GST collection will be 1 lakh crore. But the real economy was saying that GST collection has dropped to 50,000 crore. So when you say real economy and stock market is disconnect, that is not true. The disconnect is only in the outlook. Real economy looks at the past, stock market looks at the future. And not that always stock market is correct. Many a times it goes wrong in predicting future, but that's a separate matter. So there is no disconnect between real economy and stock market. Both of them move in tandem. We have to remember that stock market is trying to discount future, sometimes right, sometimes wrong. And that's where the disconnect arises between real economy and stock market. In May 20, June 20, July 20, when GST numbers were coming lower and lower, market was discounting that future GST numbers will cross 1 lakh crore. And that's where it was trading up and up despite bad news.
The next question is how to identify multi-bagger stocks when I'm a pure investor.
How do you identify a multi-bagger? Well, there are various strategies. One strategy I will call monkeys to King Kong to gorilla, monkeys to gorilla to King Kong. You need to rear so many monkeys, and some of those monkeys will become big enough to become gorilla. Please invest more money with them. And one of that gorilla will become as big as a King Kong. And then you can tell the world that, look, when this King Kong was monkey I have invested, don't tell the world about other monkeys which have died. So that's one strategy. You throw so many darts, something will stick. But in this strategy, most important thing is to let your profit grow, let your profit run. The second thing is all about observance. I'll give you two real life examples about how common men using observance power picked up multi-baggers. If you remember HDFC Bank, their first branch was opened in Sendo's house in Worli. There's a lady whom I know who used to go to drop her husband in that complex. And she also used to go to pick up her husband in the evening. While dropping her husband, she saw that HDFC Bank branch is crowded. People are starting early and they are constantly seeing customers. While picking her husband in the evening, she also saw HDFC Bank is still working. She recognized that compared to PSU banks, which were opening at 11 and shutting at 3, and in between taking lunch hour, HDFC Bank opens at 9 and works till late in the evening at 7. Undoubtedly, this bank will do well. She bought HDFC Bank and stayed on it. It turned out 100 bagger for her. Simple power of observations. Similarly, there is another lady who had gone to see in, so PVR's first multiplex came in a shopping center called Priya, or a commercial place called Priya in Delhi. Earlier, we all used to go to Dabba Theatre. वहाँ पे चूहे दौड़ते होंगे, and the screen was bad and the atmosphere was bad. There were few exceptions, but by and large, they were large theaters. They were showing us movie, but not giving us experience. And then PVR opened in Priya complex, a multi-screen, a multiplex. The whole experience was totally different. It was a small theater, but giving you an experience of watching a movie. The food quality was good. The seats were comfortable. She realized that in India, where people don't have many options to do outdoor activity, multiplexes will take off. She went and bought PVR. Over a period of time, as people moved from Dabba Theatre to multiplexes, PVR stock became a multi-bagger. You as a consumer has to find out where your money is going. And if you can pick up that trend and stay invested on it, I'm sure you will find 100 baggers.
So the next question is a very interesting question, which asks, do we ever compete with China again in economy?
See, China is 5 times bigger than us. How can we compete with China on a standalone basis? We are equal to China in terms of population, near equal to China in terms of population. But economically, we don't stand a chance. They are 5 times bigger than us. We cannot compete with China head on. We have to use techniques like Chhatrapati Shivaji Maharaj adopted to fight the Mughals. Mughals were bigger, Mughals were larger. Chhatrapati Shivaji Maharaj had to be nimble. He had to fight guerrilla warfare to neutralize Mughals' large size. So, as India, we have to fight or compete on a guerrilla warfare basis with China. We can't take them head on. We have to use shortcuts to defeat them.
The next question is, what is your view on having a term insurance policy vis-a-vis an endowment policy or an ULIP?
So, see, term insurance is far better. It doesn't give you any payback on maturity, but the cost is very, very low. Why do you need an insurance? You need an insurance because, God forbid, if something happens with you, your family should not lose from a monetary point of view. I believe if I die tomorrow, my family will definitely miss me emotionally, but they will also miss me financially, and hence I need to secure them. Beyond that, insurance doesn't serve any purpose. Now, when you buy ULIP, you are combining mutual fund and insurance together. And many a times, the commission which is charged on ULIP is much, much higher than what you pay on mutual fund. So mutual fund plus term insurance will deliver better result than ULIP in most of the cases. So instead of endowment or ULIP, I will recommend buy mutual fund and buy term insurance. That combination will achieve the same objectives of ULIP in a better way.
The next question is, how to select good performing mutual funds considering so many options available?
So there are more than 3,000 schemes in mutual funds, and which is why it is extremely important to have an advisor who can give you nitty-gritties about the mutual fund. You want to invest based on the portfolio of that particular mutual fund scheme. You want to invest based on the process followed by that mutual fund scheme. It is the process which produces portfolio, which produces return. Most of us go by the brand, most of us go by the past performance. Well, brand is reassuring because ultimately every brand stands for process, portfolio, and performance. But beyond brand, you also have to look at these factors to figure out whether it's a good fund or not. And which is where you need an advisor who can tell you that out of this 3,000 schemes, this 6, 7, 10 schemes is good enough for you. See, none of the mutual fund manager, including myself, will be always at the top. There will be days when we will be at the bottom. There will be days when we will be at the top. But as long as we are following a process, our day will come. Our opportunity will come. So you need to invest in funds whose process, portfolio, and performance is acceptable to you. And that a mutual fund advisor will be in a position to tell you.
So a follow-up question on that, which was also asked by one of the participants. There is a myriad of investments consultants available in the market. Amidst this, as a personal investor, whether one should trust their advice or expertise?
So you need to experience and then trust. If I say, here is Nilesh Shah, mutual fund distributor, should you trust me? Answer is no. Why should you trust me? You will only trust me if one of your friend comes and says that Nilesh Bhai is a good mutual fund distributor. I have followed him and I have benefited from it. So reference from a genuine person is one way to trust. Second is experience. If I come to you and say that please buy Kotak Flexi Cap Fund, it is very good. Does that serve purpose? Answer is no. You have to test my knowledge. Why do you, Nilesh Bhai, believe Kotak Flexi Cap is a good fund? What is the portfolio? How long has the fund manager stayed with it? What is the expense ratio? Has this fund delivered alpha or not? If it is not done well, why is it not done well? Moment you ask questions, you will realize what is the knowledge this person is possessing. Has he come for building relationship? Has he come for chipkaving you a transaction? If he is transaction oriented, throw him out. If he is relationship oriented, keep him. So you have to experience a mutual fund distributor, financial advisor to trust him. So either you need a reference or you need an experience. Other than that, please don't trust anyone.
Sir, we have 3 more minutes. Would you like to conclude, or you would like to answer one or two questions more?
Since these are last 3 minutes, let me reconfirm what I have stated. In our culture, money has not been given as much importance in certain people's opinion. But I remember what I heard many, many decades back on Dalal Street, where one old gentleman told me that, Nilesh, on the Dalal Street, we do worship of Lakshmi Mata only once in a year on Diwali Pujan Day. But we do worship of Saraswati Mata every day to make money. As chartered accountants, we are all pujaris of Saraswati Mata. And that knowledge we have to use not only for us, but also for our clients. Every chartered accountant by default is a financial advisor for his client. I'm sure all of you keep on receiving calls from your clients about investments. They trust you, they depend upon you. And that's the reason why it is extremely important that you should pursue a proper financial plan for yourself, and you should also pursue for others. As I mentioned earlier, investment is all about common sense. Some of the best legends of Indian investment world are neither engineers nor accountants. They are simple common men, and they have done extremely well. You need to be an optimist. You need to be a believer of India. You need to be a regular investor. You need to be a disciplined asset allocator. And you need to be a long-term investor in order to make money in this rising tide of India. It doesn't matter whether you have earlier participated or not. It's never too late to start. And I'm sure if you follow this particular path, you will reach nirvana, you will reach financial independence. Money doesn't buy everything in life, no doubt about it, but money does buy so many comforts and luxuries which will make life livable. Thank you.
Thank you, sir, for a wonderful session. Before I conclude this session with an vote of thanks, the one thing which one thing which the organizers have put across should have re-engineered it, should have kept today's strategy first and yesterday's joy of sharing today, so that it would have been easy for people to share after earning. Let me start by concluding the session with a note of thanks, sir. It's my privilege to extend a vote of thanks to CA Nilesh Shah, who has joined us from Mumbai. It was an impeccable session with some of the great takeaways, reassuring us that the financial independence is all within our own goals, just that there is some amount of discipline. All through your session, the reaffirmation of the fact that financial discipline is as important as goal setting. I think these were the takeaways. Few things which probably you started where trading is injurious to health, or which I personally liked was the optimism of greed and fear, or the talk about setting goals for a long-term investors. These were all some of the takeaways which we had. I'm sure we would love to hear you once again at all the KSA conferences, programs, and seminars, sir. With this, I extend a wholehearted thanks, appreciation for joining for today's session. Thank you.
Thank you. All the best.